Kick it off. John Lindsey, co-founder and president of Lindsey Self-Storage Group. As Travis mentioned, my family's been in the business since 1969. My dad started building sites in Dallas, Texas. I grew up pouring concrete as a kid and then launched Lindsey Self-Storage Group in 2012. We now do brokerage all over the U.S., Europe, and Southeast Asia, and been fortunate to work with Jay on stuff all throughout the great state of California.
I'm Jay Allen, co-founder of Performance Self-Storage Group with Carl, who everyone pretty much knows here. Like John, specialized in self-storage brokerage, done about $1 billion worth of transactions. Also, we have a big ownership share in a bunch of properties nationwide.
So we're going to give you guys just kind of a quick overview today. We do have lunch in about 15 minutes and a little overlap with Neil, so we're going to run through these. So we're going to talk about some of the trends saw in 23, where we're seeing rental rates and occupancy trends. That's really important today, as Neil mentioned, for valuing stuff moving forward. Kind of some of the new supply issues, potential distress, and kind of what lies ahead for us. You guys are really aware of some of the major transactions that happened last year between Public and Simply, and then Extra and Life, obviously, $15+ billion worth of major transactions. The majority of all this happened in the first half of 23. 84% of deals happened in the first half of 23. And for us in particular, my firm, we closed over 30 deals last year, 85% of which closed before August 1st. So we saw this huge slowdown in Q3 and Q4. There was this huge bid-ask spread that no one could really fit a box for, and really no one was closing a ton of deals the last 3-4 months of the year. And if you did get one done, kudos to you, because it was a very, very tough time in our cycle. The things that we did see in 23, though, there were less buyers because of the debt environment, but those who were buying were super strong, either all cash or low leverage, as Neil mentioned. They were really performing well. Jay and I had a couple clients in particular that closed over 50, 60 deals last year each. Some were closing none. So the ones that were around were able to pick up a ton of deals, which was great. A lot of regional focus. We saw a lot of groups kind of pull back in and focus on their backyard. Not as much buying one in Texas, one in Kansas, one in Florida. Starting to really kind of pad in and build those economies of scale with these more expensive debt rates we were seeing. Obviously, as I mentioned, biggest pushback was price. That bid-ask spread was through the roof on a number of assets. Sellers looking back, buyers looking forward, kind of an issue there. Biggest question we got last year was, is seller financing available? And for the first time in years, the answer is yes, it's back. We've done a number of deals with it. We're having a lot of sellers more open to it now with the current rate environment. They're understanding the benefits of it now. And we're seeing a big pullback from the rural and tertiary space. Again, you're buying a 5-cap deal in tertiary North Carolina when you're getting 3% debt. That's great. Really tough to make work with an SBA loan at 8-9% these days.
So as far as California is concerned, that's our bread and butter here. Last year, I tracked about 50 transactions, of which 18 were part of a portfolio. So really 32-ish, 33 deals last year. The year before, 2022, 70-plus transactions. It was a huge year. What's interesting to note, last year, 50% of the transactions I knew about, and there's a lot of stuff that happens behind the scenes, were off-market. Very interesting how the buy-sell process has been changing a bit within our industry here. A couple portfolio sales. Last year we had the Storage Etc. transaction bought by StoreQuest, which was actually a carryover from the previous year. And Prime, which is one of the largest privately held self-storage companies, they bought the Storm California portfolio. As John mentioned, sellers are always looking in the rearview mirror when the market's going down. Buyers are looking forward. We're still seeing that, but the bid-ask spread is narrowing a bit. So sellers have become more educated by guys like us and the market. So we're hoping for this year there should be some more transactions. As Neil mentioned, we are coming into a normal debt market. 5.5 hopefully is probably where it's going to settle out at. But the deals that we did take to market last year, which was not a lot, we did receive multiple bids. We are still seeing multiple bids. There's a lot of cash on the sidelines. They want to buy. They're getting antsy to buy. But right now, especially in California, I know of 2 storage properties for sale. That's it in the entire state of California.
Yeah. So a lot of money on the sidelines right now, especially those who didn't put capital to work in Q3, Q4. Jay, you want to talk about that?
Yeah, here's just a simple, and again, we don't have a lot of time at cap rates. A couple years ago, 3.5, 4 cap. It was a frenzy. It was insane what was going on. Seller could take a property out to market any price they want, and they would get it. There'd be 10 to 12 offers. It was a great time to be a broker, I'll tell you that. Right now, it's a challenge. And again, for California, I'm being very specific, there's just not a lot of properties on the market which will help compress that cap rate. So if you own anything in California, people say, what's the cap rate? What's my deal worth? It's a loaded question because you have retail deals that are professionally managed. They have market rents. There's no low-hanging fruit versus mom-and-pop upside deals. There's a big spread between the two when you're looking at the cap rate. But if someone asks me, hey, if it's an upside-driven deal, what's the cap rate? 5-ish, somewhere in that range. Again, these investors, they can leave their money in a money market account and earn 5.2% today, sitting at home doing nothing. So there's got to be a reason for them to buy. Retail deal, those are tough. Professionally managed, top MSA market. I met with one of the big institutional buyers last week, and I said, hey, look, I got a deal. It's managed by Extra Space. It's 100,000 square feet. There's no upside. What would you pay? He's like, guys, we're buying this like a bond. We'll buy something 5.5% today. They did buy a deal last year in Pasadena, and they paid a 4 cap. So that 5.5 could easily turn into a 5, especially if there's a bidding frenzy and they want the deal.
So in the rest of the country, we have offices in Texas, Louisiana, Florida, Minnesota, Illinois. We're kind of all over the place. We have seen a huge shift, and I think an even larger one than California is seen kind of across the board. What was the Class A, B, core markets, your Atlantas, your Tampas, Charlottes of the world, they were trading in the 5s, and now they're pushing up into that 6+ range. You go all the way down to the super tertiary markets that people were getting really aggressive on with cheap debt. Again, they were paying 5-6 caps back in the day, just gobbling up everything they could. Again, if you're going the SBA route or you're borrowing some super high leverage money, you're going to be paying 8+%. So we've seen stuff trading at 8.5, 9 caps even in some of these rural markets. But there has been this flight of capital back to core markets in this time of uncertainty with debt. But with all the sideline capital we saw last year and the expected rate cuts this year, as Neil pointed out, I think we're going to see a lot of compression in that valuation again. Here you can see kind of cap rates by asset class, all the way from industrial to office. You can see the swing of who was hurting the most during 21 to 24 and what that shift looked like. You can see storage just 4 items in, a very minimal shift, 4 to 6 cap. It's kind of what Jay and I have seen across the whole country. In some ways we weren't the best, some ways we weren't the worst industry, but again, storage does very well in times of downturn. So we consider ourselves super fortunate to even be trading where we are and for there to still be transactions and capital chasing deals. Year-over-year home sales, we've talked about this. There's this huge migration issue. Mortgage application rates are down 90% year-over-year. People aren't buying homes with 8% debt after we've been spoiled with sub 3% debt for years. So as Neil pointed, it's been a huge impact on our business nationwide. But as this is starting to loosen up, I think this will positively impact our industry moving forward.
Yeah, here was I tried to find a representation, a graph of the shift in rents. So I went back to some old emails. I found this graph from Yardi, which is a great resource. This is year over year 2021. Life was good to be a storage owner. I mean, we were pushing rents 15, 20%. Who would have thought that would change? So now we go to 2022. Some things are starting to happen here. And things are starting to flip-flop. And here we are today. Pretty much every single market throughout the nation is seeing negative rent growth. And a lot of that has to do with what John just mentioned, slowdown in residential real estate sales. And also, we got the REITs. I mean, it's a challenge right now with rents. What's going to happen in the future? I don't know. I don't know if we have to wait for the REITs to fill up and then they're going to stop this REIT rental game. Who knows? I have no idea. But it is interesting seeing how quick things changed within our industry, which a lot of us didn't know was going to happen.
And I think it's really interesting. It's not just one region in the country. It's Phoenix, it's Raleigh, Durham, it's Tampa, and again, a lot of these are hot growth markets where we've seen this boom and bust. So it's not saying don't buy or don't build in those markets, but be cautious in the decisions you make. What was a 3-year lease up, maybe a 6-7-year lease up now. So patient capital will survive well in these markets, but the first-time builders with floating rate debt, we're starting to get a lot of calls in some of these markets to help alleviate their concerns. As Jay pointed out here, we're seeing this, sometimes 10, 20% down in certain markets, and we'll be interested to see when that spring comes back this year.
And here we got the re-rate games. This is fun stuff. We're all dealing with it right now. I'm curious in this room, how many people raised their street rates last year? Anybody? Actually raised the street rates. Okay. Who lowered their street rates? Pretty much everybody. I'm curious, how many of you, when you looked at your financial statement at the end of last year, had NOI growth? A lot of people. Yeah. So, I mean, that's the strategy of the REITs. We get them in. They're in. Once they're in, we jack them up. Travis, great article about all of that that's happening. You know, do you follow suit? I mean, like, what do you do? You know, there's got to be, I think, for us, some rental rate transparency, and you got to tell the tenant, hey, you're moving in for $25 a month. Just so you know, we are going to raise your rent. Here's an addendum. I want you to be fully aware instead of just blindsiding these tenants, because that could lead to negative reviews, news media. You know, we're kind of this little bubble. We don't want a lot of people knowing what we're doing with the rents. We like it. We can do it when we want. But what the REITs are doing, I think, is it's a bit dangerous. And we'll see how it plays out.
And it's, on our end, too, it's making it very challenging to properly assess certain deals in certain markets. When we go in to look at a market, we're trying to take all the historical data that we have from other deals we've transacted on, other owners that are open with sharing their in-place rates, and really trying to really adjust for what is actually being collected in these markets. Because if you go off just the street rates, you're not going to make any deal pencil in today's market.
Content, and yeah.
And here we got a great graph about the new supply hitting the market. I will tell you, our phones have been ringing off the hook from development deals that are becoming abandoned. I mean, because they're figuring this out. Hey, look, the rent's gone from $1.80 a foot to $1.20. We're into this deal. We've been trying to process it. It doesn't make sense to build. So I think, although there is a lot of new supply hitting the streets, there will be a fair amount of land development deals hitting the market where these developers are just doing whatever they can to get out of it because they've realized it just doesn't pencil anymore. They were using rents when we were pushing rents 10 to 20% a year. We're no longer doing that. We're doing the opposite.
Yeah. And as Jay mentioned, you couple that with a floating construction loan and rates going down 40-50%, you're in a world of hurt very quickly with your deals. Yeah. As Neil touched on, we're gonna skip through this Fed funds rate, the shift we've seen every year, where the 10-year Treasury's at today for those borrowing off it. Again, we're hoping that all this starts to pull in as we go through this year. I think this is the most important slide that we have today. Jay's going to walk through that exact construction deal that we've seen time and time again. We have underwritten so many of these in the past 90 days with first-time builders or floating rate builders coming to us with this exact scenario, and we're going to see a lot of brand new, beautiful Class A product come up for sale this year because of this exact situation.
So I'll run you through this because I know we don't have a lot of time, but okay, left-hand side. This is the development pro forma, okay? 100,000 square feet, market rent's $1.85. We get a gross potential of 2.2. Vacancy 10, blah, blah, blah. We come down, we get an NOI upon stabilization, and there's a development deal, okay? $1.2 million. When times are good, 4.5 cap all day long. I get a $27.5 million value, okay? It cost me, now right next to there, about $13.2 to build it, okay? I put 25% down, rate was around 9%. Again, this is just a very broad example, okay? What happened? Okay, we build the deal. Well, the market rent went from $1.85 to $1.40. In most markets, it went further down. The gross potential got reduced, and our vacancy, we're no longer, we didn't hit 90%. We hit 75% economically rented. We come down, and now we got the cap rate shift. Went from 4.5 to 5. Well, that deal is now worth 15.6. But wait, our construction loan's coming due. Uh-oh, what do? Well, we got a refi. No problem. But, oh my gosh, the appraiser just valued our deal, not at 27, at 15.6. Our current loan is 9. The rate is now 6.5%. That's a 1.04 debt coverage ratio. It's not going to work. Cash in refinance. You only have a couple options. 1, you give the property back. 2, you sell it at a loss, right? And remember, my development cost does not include the cost of the land. Okay, that's not even part of that. So it's even a bigger loss. Or you go to your investors who have made no money. You took 2, 3, 4 years to entitle them to build and say, look, you know, the brand new deal we just opened, we're not making any money and I need more money. I need more money for you or we're going to lose the deal. This is starting to happen. Not everywhere, but this is definitely starting to happen.
we're seeing a lot of first-time syndicators come up with this issue. So be aware of developments in your market. We track the debt closely. We've got about 1,200 loans that we think are coming due this year with some bad debt. So we'll be curious to see how that transitions. There's some other interesting defaults. If you guys want to go over these with Jay after, he'd be more than happy to share. But we want to flip through those in the interest of time. Jay, you want to talk about cash?
Unfortunately, our video doesn't work, but he's saying, show me the money. I mean, that's what lenders are going to say. Show me the money. Where's the money? You know, it's happening. It is happening.
So right now, I think this is the most important thing. People always ask me, like, should I buy or sell? Where am I at with my portfolio, my deals? And I think we're actually in this like happy middle ground where you can be both a buyer or a seller depending on where you are in the life cycle of your deal. If you bought pre-2020, we can sell your site and you'll make money. No questions asked. You bought at a great time before this great pop and boom came into storage. If you're looking to buy, it's also a good time where there's a lot of people who can't afford to buy, people who don't have as great of access to capital or can get the type of debt that is available through life co-size loans or things of that sort. So it is this happy medium where I think for the first time in a couple of years you can be a buyer or a seller. And some of our bigger groups we work with that have 100, 200 stores, they're horse trading. They sell some, they buy some. It just depends where they are in that process. Rates coming in this year is great. Watch out for your balloon loans in some deals, and if you're able to refi at all or cash and refi. Liquidity is king, always is, always will be. And we had a lot of clients through last year pay cash or do 50-50 debt. And I think that's what will survive times like this. Selling's not your only option. We have clients that love JVing or helping you get creative with structures or management agreements, things of that sort. So if you're in a tight spot, don't think that your only option is to give it back to the bank or to go through that process. So feel free to call us with any recommendations. And I think the biggest one, and I tell people this all the time, is your opportunity cost. You know, a lot of sellers look back and say, well, I could have gotten 4.5 in 21. You're telling me I can only get 4.1 today. I'm like, yeah, well, you bought it for $2 million 5 years ago. You're still making $2 million. So, you know, what do you care? I'm like, to get back to that value that we had quoted you, you're going to probably have to wait another 3 or 5 years. So, you know, burn the hand mentality, I think, in this day. I hate to use the phrase, but kind of catching the fallen knife. We have missed the peak of the market. We are still in a very great relative spot, though. And so if there's an opportunity for you to clear chips, now is a great time to take advantage of that. Rates are coming in this year. Pricing is going to be wonderful. There's a ton of pent-up capital. So I would certainly say take advantage of the market if you're even questioning it this year.
So what lies ahead? Properties in distress, no doubt. I think, though, there's so much capital, as John mentioned, on the sidelines, waiting to strike. So I don't think it's going to be a bloodbath this time because there is so much money out there. Cap rates 24, Neil mentioned, they're just going to I think hang where they're at unless all of a sudden rates do really come down. But even then, I still think that 5-ish, and I'm talking California, 5-ish range. There's still sellers that think we're in a 4-cap market. I wish we were. We're not. But mid-5s is kind of the new norm right now. Investor sentiment, cautious optimism, I think are the words. Everyone's cautious, but they're optimistic. I want to buy, but I'm going to be really strict on my underwriting. So, again, John mentioned there is a lot of money. So for this on the sell side, the pricing is still very good. I mean, you're talking a 5 cap. I mean, historically, self-storage. Carl, 9 cap when you started? 9, 10 cap?
Interest rate was 8, cap rate was 10.
And now we're selling deals at 5. I mean, but forget about the 4 cap. Those days, they're long gone. Forget about that. Government regulation, rent control. Steve Marabito, Storage Pro, wrote a great article about this and his fear of rent control in our industry because of what the REITs are doing. Definitely read that. I highly recommend reading that. And let's see what else we got here. New supply. Yeah, we touched on the new supply, but
yeah, it's going to be an issue in a lot of markets still. Again, it's all the hot growth markets, the Bible Belt, Texas, everything like there, but it's a short-term issue. So plow through it if you can. If anyone's curious, we do this a lot. We look at appraisals. We help provide comps, street rate data. We do valuations quarterly. Whatever y'all need throughout the country, California, anywhere else, we'd love to help y'all in any capacity. Even if it's a new build project, you want to compare and contrast what else we've seen in the market. Jay and I both have billions of dollars worth of transactional data we'd love to share and help you guys see where your project's going, whether it's 6 months or 6 years. We're not going anywhere. We've been here a while, and we're going to continue to be here. So feel free to use this as a resource, and we'd love to help in any way we can.
And thanks to Storelocal for asking us to speak, and especially Karen. Thank you, Karen.
Absolutely.
Amazing event.
Thank
Thanks,
you, guys.
guys. Appreciate it.
Great job, guys.